The landscape of American home ownership has shifted dramatically, with the 30-year mortgage rate soaring to its highest since the early 2000s, reaching a staggering 7.6%. This surge has sent ripples of concern through the market, with many questioning the stability of the housing sector. What seemed like a minor hiccup has ballooned into a financial bubble of epic proportions, one that may well go down in history as a cautionary tale of economic excess. The journey to this precarious point is a tale of past patterns and future warnings, a narrative that underscores the fragility of our current economic framework. The impending housing downturn is shaping up to be unprecedented, and to understand the gravity of the situation, we must delve into the annals of history, examining the real value of housing prices when stripped of inflation's deceptive veil. Strap in, because by the end of this video, you're going to be shocked at what's coming in the near future. Consider this. A home purchased in 2000 for $200,000 would need to be valued at around $356,000 today to break even when accounting for inflation. This is a critical perspective often missed in standard analyses. To accurately gauge the bubble's magnitude, we turn to the inflation-adjusted Case-Shiller Index, which reveals the true escalation of home prices free from the distortion of a weakening dollar. Current data shows that we've eclipsed the previous housing bubble, once thought to be a monumental anomaly in U.S. history. With records dating back to 1889, we see that the 2008 housing crisis reached what was then considered an unreachable zenith. Yet since 2012, we've ventured far beyond what was once deemed normal, suggesting an inevitable recalibration is on the horizon. The historical context is telling. Post-2000, we witnessed a steady decline in interest rates, setting the stage for the 2008 crisis. Despite this, the Federal Reserve continued to suppress rates, inevitably nurturing a new bubble. Since 2011, the real price of homes has surged by 66%, a rate increase unparalleled in recent history, save for the period leading up to the 2008 crash. But that's not the biggest of our concerns. The crux of the argument for an impending crash lies in the relationship between housing markets and interest rates. The 30-year fixed mortgage, closely tied to the 10-year Treasury note, is a bellwether for housing values. Currently, the yield curve, an indicator of economic health, is inverted, a historical harbinger of recession. This inversion has preceded every major economic downturn from the 1980s to the present day. The bond market's current skepticism is a telling sign. The similarity in yields between the 10-year and 30-year treasuries suggests that investors are bracing for continued inflation, preferring short-term securities despite traditionally lower returns. This behavior indicates a lack of confidence in the market's direction and foreshadows potential turmoil. Before we share the number one battle that will determine the fate of the market, if you found this video helpful, subscribe to our channel to stay up to date with financial news, tips, and advice to be prepared for the economic disasters that lie ahead. The housing market's fate is intertwined with the Federal Reserve's battle against inflation. Should the Fed relent in its aggressive rate hikes, it may signal the onset of a crisis, potentially unraveling the housing market gains since 2012. We'll keep you up to date with the news. Considering the implications of a housing market crash, it's crucial to recognize its impact on both homeowners and investors. Rising interest rates could spell trouble for those with adjustable rate mortgages or those seeking to refinance, possibly leading to an uptick in foreclosures and a flood of undervalued homes on the market.